And so we wanted to make sure everybody got an update. So we've got the entire advisor team here today. So we've got Bill Davis, Beth Foley, Matt Arends, Cliff Hawkins, along with myself. So we're hoping to give a good update, talk about what we see currently, talk about some of the challenges and what we call headwinds in the market, and then also talk about where our models are, and all of you know that we have a partnership with Helios that provides us with data, so we want to talk about that. And in the background is Marla running the slides and so forth. So let's go ahead and move forward. And so really our three discussion points are volatility, inflation rates. We want to talk briefly about a possible recession. This is all kind of in the future, but as we progress here in 2022, there's been more signs of a possible recession, and kind of where are the Hilltop models today and where we see them going. So those are the three kind of main topics. I would encourage you, if you've got questions, you can type them in to the question side of it, and we'll try to answer them. We also had some other questions come in prior to our session, so we'll certainly give those to you as well. So if we move on and start this discussion, to the next slide. So Bill, why don't we start with you? We've been saying, unfortunately this year, there's really no place to hide.
Yeah, that's exactly the tone, Eric, is there is no place to hide. And I've been trying to get people to understand that we're experiencing something that's similar to 2008. I would say that the difference is that the equity markets have had less of a decline than we saw in 2008. But in 2008, the bonds did not get as negatively affected as they have been through the first quarter of this year with rising interest rates. So I would take your eyes to the 3, 5, and 10-year numbers and ask yourself, where do you want to be as it relates to the rates of return from the top part in equities or the bottom part in fixed incomes? And it continues to point toward more favorable treatment of equities, thus being in the moderate toward moderately aggressive mix. So that you're overweighting equities versus fixed income, because you can see you didn't even make inflation back in the fixed income market. So I think that the fixed income markets will stabilize as the par value catches up with dividend payments. But as you can see, it's been a bloodbath across the board. And as we've reduced risk assets, we have taken the money and put it in assets that have become just as risky with the movement in fixed income markets.
Yeah, thanks, Bill. And Beth, we've been all doing this a long time, and this bond side, I don't know if I've ever seen it like this, like Bill commented. You look at that the U.S. corporate 10% negative over the last year.
I think about this back to 2004 was the last time I can kind of recall such negativity in the bond market because of the interest rate adjustments. But we've also not, in our adult lives, like fully adult lives, we've not experienced this level of year-over-year inflation either. So more extreme measures. It's the same sort of activity to attempt to bring inflation under control, but just bigger numbers right now because inflation year-over-year has been so much higher. I think we're all hoping to see some of that inflation rates begin to crest. CPI index is announced tomorrow. We'll see what that looks like. But just as, if we go back to 2015 or the Fed is walking this fine line between a hard landing and a soft landing of trying to navigate their way through something that hasn't really been experienced since 1982.
Yeah, that's a good point. I heard that too, that there've been a lot of folks that have been investing, haven't seen this kind of inflation at all, in their investing career, if you will, since they've been investing. So Matt, a lot on the Fed. This is one of the things that's causing this volatility is the Fed. And we wanted to show this graphic and kind of go through at least what the markets are pricing in right now.
Yeah, exactly. You know, the markets really are have this expectation that as the Fed raises rates, you know, early on that was kind of extrapolated out what earnings would look like because of that. Particularly when you look at increased wages across the board and supply chain issues and but people spending. And so as the Fed announced early in the year that they were going to raise rates, pretty robust in doing it, the markets you know, repriced essentially. The unfortunate part is that inverse relationship, to Bill's point, with fixed income and interest rates. Rates go up, bond prices will go down. And you know, the good news in that is really just a snapshot of what bond prices would be if you were to sell. What we do know is equity or fixed income managers traditionally will hold on to those. So, you know, those par prices will come back up as they creep to maturity dates. But the longer the duration of those fixed income assets, the more negatively influenced they are. So our expectation is, you know, the short-term yields are around 2.5%, and the Fed funds rate just has to catch up to that. So the market's kind of pricing in where it believes the Fed is going to go. For us, the expectation or the hope really just means that a lot of this is priced in. We probably won't see as much movement going forward, with the expectation that, you know, the Fed will raise rates another 50 basis points here in the next meeting, and then again in July. So that's the hope, is that you know, they follow through with what they're saying. But again, it's kind of that double-edged sword. We need rates to go up so that, you know, you as an investor are getting paid for fixed income assets. But really, that's the only way to curb inflation from a Fed policy at this point. So again, we want prices to slow down. We want inflation to slow down, and there's really only one way that the government knows how to do that, or has the ability to do that. And that's raising rates. So again, it's a tough position for investors to be in, but it needs to happen.
Yeah, and you know, that's a good point, Matt. And you know, Cliff, we've talked about this as a committee, that we don't know if the Fed's too late, really. I mean, I don't know if anybody knows. Maybe they should have done this sooner, but we're here now, and we got to deal with it, right? Cliff, did you catch that? There you go.
Cliff, you're on mute, buddy.
Yeah.
There we go. I'm off mute.
Okay, there you go.
You know, there's been a lot of people, a lot of analysts out there saying that the Fed was late to the party. You know, that the inflation wasn't transitory and they should have reacted a little sooner. But the fact of the matter is, here and now is where we sit. So to Matt's point, actions have to be taken. You know, they're already looking at, you know, 50 basis point increases for the next 2 meetings. You know, so those are already essentially priced into the market. And, you know, if you look at the graph here, there's another 50% chance that another 25 to 50 point base increase will happen further in the year. And, you know, what I'm hearing is that there's probably going to be another 50 base point increase, so at least 3, or 4 rather, not just the one that just happened plus the next 2. There'll be another one, you know, because when you look at it over the last, since World War II, there's been, you know, 13 hard and soft landings and 10 hard landings versus 3 soft landings. So the delicate dance is to increase rates, but not so much that we crater demand, and do enough though so that prices go down. So that, you know, that's the delicate dance that the Fed has to kind of figure out. But, you know, the Matt's point, something has to happen because rates do have to go down.
Yeah, it's a tough position to be in on the Fed right now. So if we move on to the next discussion point, let's talk about kind of commodity performance. You know, Bill, no surprise, energy's up. I mean, we're feeling it here, right, at the pumps. No surprise there. But we wanted to show kind of how commodities lie out here.
Yeah, and I think, you know, a lot of this, as we all know, is driven by the war in Ukraine. And you know, when you have countries that are supplying a lot of commodities, especially in the agricultural area, that's an issue. Cutting off Russia from energy is an issue. And so we just this is a challenge. But we've done some weightings, sector weightings, and changes in the clients' portfolios to take advantage of some of these. But I don't expect energy prices to be moving downward anytime soon.
Yeah, doesn't appear so anytime soon at all. So if we move on to the next point in what we wanted to talk about was, this is kind of interesting, Beth, with kind of past, even though it is a past, and you might want to explain this to folks and kind of how this might be helpful in us thinking about it.
Sure, absolutely. I'm trying to look at the exact date in here, but about 3 weeks ago, I noticed, and I think all of us noticed, that the word recession was creeping into the media, into the news, and all of that. And the reason for that is that date, whenever it was, about 3 weeks ago, the yield curve inverted. And what that means is that short-term interest rates had become higher than longer-term interest rates. And to Matt's point a moment ago, you should be paid for having somebody hold your money. And the longer they hold it, the more they should pay you because you don't have a use of it. And so when the yield curve inverts, it means that shorter term, you're going to get paid more for a shorter period of time. And that activity led this word recession to start creeping into dialogue. So what this graph shows is trying to take some of the heat off of that and the worry about it. What this graph shows is going back to 1978, the dates at which the yield curve inverted. We all remember that you don't know you're in a recession until you're out of it, or when the actual date starts. So back testing it, it said, all right, August 17th of 1978, the yield curve inverted, and there were 532 days until the recession was deemed to have actually started. And as you go through this column, you can see it's a significant amount of time, in most cases over a year, or close to a year, between when the yield curve inverts and when the recession actually begins. And then, reading leftward or rightward across the graph is what the S&P 500 did 6 months, 1 year, and 3 years after that yield curve. And this graph is here to say, yes, we acknowledge that the word recession is coming into play. We've had this yield curve inverted, and we've had a quarter of negative GDP, which is the other kind of way of saying, all right, we're in a recession if you have 2 quarters of negative GDP. And that really isn't a true definition. That's the one that we adhere to because it's easy to remember, but it's an extended period of time of volatile or negative activity is what a recession is, or it's signaling the start of it. And that's why, we could be in a recession right now. Except that we have a really strong labor market and we have really strong consumer spending. So we've got these signs saying, okay, here's some indications of recession, but over here we've got these other indications that say we're not in recession. So we included this graph just to say, just because the word appeared does not necessarily mean that we are imminently going to have a recession, but it's also not saying that we're not in a recession right now. Time will tell on all of that, but good things can result. If you look at those returns in the S&P 500, following all but the 2000, 2005, 2007, and 2007 was certainly an outlier in there as far as negative returns 3 years after the start of the recession.
Yeah, I think that kind of tells it. If you're not in it, it's going to go quick. So that's 1 year returns kind of show it up. So thanks, Beth. So, if we're thinking about this, if we kind of move on to the next graphic that we wanted to talk about and go over, there's a lot going on with this. And Matt, maybe I'll ask you to just kind of explain what we're looking at here, because this really shows returns during the year and where the markets end up at the end of the year. And often during the year, investors may be thinking it's not going to be a good year. And then, oftentimes it ends up being a good year.
Sure, Eric. I think I love this slide. I think it shows the reality of volatility. And I think what it really illustrates right now is we're not used to volatility. We're not used to pullbacks in the market. We've kind of just had this nice steady increase. Take the anomaly of 2020 out, with the start of COVID, but then a massive recovery. And so, even if you look at last year, down 5%, a couple years before that, down 7%, down 3%, down 11%. There's really not much in the way of pullbacks. Quite honestly, with massive upside of gains. And so what we're experiencing right now, when you look at this and it says the average drop in the market over this time period is 14%, and that's really where we are for the year. So it's not unheard of, it's just uncomfortable. And it's primarily uncomfortable because, again, we've not seen massive volatility over the last 5 to 7 years, aside from a year or two. And that comfort level is usually not as bad either, because you're making money in your fixed income assets. So if you do pull back a little bit, you still have some part of your portfolio that's generating a return to offset that downward pressure in equities. But again, you go back to that first slide and you say, well, my equities are down 14, but my fixed income is down 10. So there's nowhere to run. That's really what's creating this massive uncomfortable level for most people, and what we're seeing in portfolios, especially those who are more conservative. We just haven't seen the fixed income market have a drawback like this for 20, 30 years. And so it's a massive amount of uncomfortableness. But again, we have to navigate it, and it's just the reality of where we are.
And throw this out to anybody, but one of the questions that we had was, when we are de-risking, and we're going to talk about our models more here in a minute, but we're de-risking and going from equity to fixed income, and fixed income's down. So I know in our models recently, we put some more cash in the position, but anyone on the panel, if you want to just talk that through for those folks listening, and kind of how we're going about it.
Can I say one more thing about this slide before we move on? I mean, in this 42 years, there's 8 down years. There's only 2 down years since the crash of 2008. And those were what, a -6 and a -1. And so put it in perspective, 2019 mid-year, we were down 34 and finished up 16. Talk about schizophrenia.
Yeah.
And so, the fact that we're facing the headwinds that we're facing right now at a -14 point, through the first quarter, there's a lot of year left. And, there's some years that we had a lot worse in the 30s and the 20s that the market returned, double-digit numbers. So yeah, I think the uniqueness to your question, Eric, is the fact that as we've dialed down risk assets in our portfolios, it was very difficult, because where you were dialing to was getting hammered more, as much and more than we've experienced, to Matt's point, in 40 years. And so thus this quarter, at the beginning of this month, why we actually went to some cash, so that we could have some dry powder when the dial start dialing up, or the switch gets turned on to move back to the equity risk, to the risk assets. We're going to have that dry powder there ready to go to work.
And it's a good point, Bill. And the thing that doesn't happen is they don't really give us much of a warning. The market doesn't say, okay, I'm going to tell you in 30 days, we're going to start going up. So if you're not kind of on the train, and you make those changes and adjustments quickly, then you miss out on a lot of the upswing, and that's the other reason why making changes, when things are down, you definitely lose. So you lock in losses. So that's a really, really great point. And so it's got a lot of good information. Anybody else have any comments before we move on?
Yeah, I think, just real quick, the going to cash is something that we have not really ever done, 20 years for me. And we have never put 12 to 15% in cash, but knowing that the fixed income is going to continue to have headwinds, it doesn't make sense to continue to participate, particularly in anything longer duration than the 2 years. So, we still own some because the short-term fixed income is actually yielding 2.5%. Will be limited by duration movements in the Fed rate, and the rest basically in cash. So the massive overweight there says we've kind of pinched off, greater losses that we can experience there for the short term. But it's not like we've pulled fully out of the equity market. We still own it. We've just maximized and moved up capital a little bit. But to Bill's point of just saying, hey, we'd rather have money sitting, not losing for a very short time period until the Fed kind of figures out this rate movement, and then be able to pounce back into just fixed income alone, so that you have already taken advantage of the share price drop, and now you're buying low essentially with a higher yield. That we believe will help, particularly in the bond market recovery within especially more conservative portfolios.
Great, thanks. Cliff, I think you were going to make a comment there.
Yeah, just briefly, I was just going to jump on Bill's soapbox, with this chart. What we do for our clients, we're not day traders. This is a snapshot of what long-term compound growth looks like. That's why we talk about it all the time. We want our clients to understand the moves we make are in their best interest. And again, it's for long-term compound growth. It's not just for today, for tomorrow. It's for decades down the road. And this is what it looks like, So this is, we're dealing with things that are uncommon, but the volatility is extremely common, right? And I tell my clients this all the time, long-term growth is not short-term perfection. So, there's times we're going to have to deal with some bumps and bruises, and it'll happen again, and we'll navigate through it and deal with it, but it's going to look very similar to what we see on the screen now.
Yeah, it's a good point.
Yeah, I'd like to jump on to this as well, because I think that the advantage that we have is the process that we've been following over the past year and a half. I know that I feel better about the process today than I ever have in my career. And with regard to the cash that we've put on the sidelines, the intent, that cash came from the fixed income part of the portfolio. It didn't come from the equity part. And we need to stay invested in equities because we don't know when what the trade is going to be to push us back into positive territory. But the real advantage that we have is that we're looking at all of these numbers on the 1st and the 15th of every month. We're looking at the data in real time and making decisions from there. We're not guessing as to where things would be. We're not going to try to guess as to when to get back into the fixed income part of the market. We've got data. We're going to talk a little bit about, on emotional investing and just looking at the data that we have in front of us that doesn't know what happened last week, doesn't going to try to project what happens next week. It's like, what do we have right now to respond to and to react to? And I think that's something that we have working in all of our favors right now that we didn't have a year ago, 2 years ago, or in 2008, the last time we went through something as extreme as this.
Yeah, it's a good point. I know another question came in is, is there any particular areas we're looking at? I guess that means sectors, those kinds of things. And, in our models, we don't sector bet. Right, Matt? So we don't shift a massive amount somewhere. And, the models do provide diversification. Mike, maybe comment on that.
They do. When it comes to sectors, it's really more, if you're looking at sectors, you're really looking more at things like healthcare, technology, energy, those types of things. And so we do rotate those based on the best risk-adjusted price returns for the experience of upside capture that you would receive based on current pricing. And at this time, technology and energy are the two places that have the best upside risk-adjusted return. So based on pricing, and that's a difficult discussion sometimes when it comes to technology, as you watch the NASDAQ get beat up, that type of thing. But again, when you look at a risk-adjusted return, it does provide the most lucrative opportunity for people. So again, and that kind of rolls right back into Cliff's point. Short-term perfection doesn't create long-term success. So while it can be uncomfortable, we do have to follow the data there for the various sectors, but we do move in and out of market cap when you're talking, equities, large cap, small caps, emerging markets. We have an exposure to Japan in some portfolios right now because that creates opportunity that we otherwise wouldn't have had. So those types of things, the models are adjusting accordingly. But it's not, looking for individual stock selection, that type of thing. It's looking at market caps across the board, even fixed income across the board, and what portion of the fixed income world can we make money in? And right now, again, none except for short term. So it cycles through as appropriate based on the data provided.
Yeah, I think about technology. I mean, you think about just a year and a half ago or so, it was all about Apple and, just looking at Amazon. I mean, it was at 3,600 a share and it's down to 2,100. But yet the 12-month target is back to 3,600. So, a year and a half ago was all about Apple and Amazon and so forth. So extreme volatility in technology as well, but that's helpful. If we move on to the next graphic and just talk about, as we go, let's talk about some keys here. So anybody want to jump in on some of our keys that we just want folks to think about as we're kind of moving through here the first half of the year?
I think the first one really goes to what we've been talking about. It's time in the market versus timing the market. And this isn't anything that any of our clients haven't heard from us before. It is this objective of long-term compounded growth over time, rather than picking the perfect time to get in and out of the market. We know that doesn't work. I have a graph that I'm looking at right now that is from Merrill Lynch, so that's why it's not up here. But it looks at a $1,000 investment made in 2011 and held to 2020. And what this graph shows is that if you do nothing over this time frame, if you put your $1,000 in and just leave it untouched, from 2001 through 2020, it'll grow to $4,222. If you miss just the top 10 performing months over that 20-year time frame, your $1,000 would grow to $1,699. And if you miss the top 20 performing months over that 20-year time frame, your $1,000 investment in 2001 actually loses money and closes out at $866. And that's just one of the, you can pull these up from anywhere to say, don't try to time the market. You're not going to get it right. You need to be there when those upticks come in and get that steady growth. And if you're not there, you can't, if you decided it's time to go in, it's probably too late. So it's time spent in the market rather than trying to time the market, the best time to go in and out.
Thanks, Beth.
The Hall of Fame of market timers is an empty room.
Yeah. And, I think about, our process. The good part is we're not just sitting on the models and just, we're trying to protect the downside as well. Now we know accounts are down and negative and people have concerns, but it's not just how much you make, it's also how much we don't lose. So, that's kind of the strategy on doing the institutional approach is looking at that long term. Recently I know I've talked about this with a few folks, but a couple of weeks ago, Warren Buffett was on CNBC for about 6 hours. It was the annual kind of Berkshire Hathaway and Charlie Munger and him. And, one statement he said is, I don't think there's been a day that Charlie and I have woke up and have come to the office knowing where the markets are going to go. So here's someone that has a lot of investment experience and certainly success, and he doesn't know what's going to happen. Over time, it's going to go up. So taking emotion out, Bill, we got to take emotion out. This is, our process is not emotion based. Obviously, emotion really can harm your overall portfolio.
Well, yeah, I mean, you can't be thinking about jumping off the cliff, right? I mean, that's worst case scenario. This is one of those events that I think that our Helios models have helped us improve losses by between 200 and 400 basis points. So that means 2 to 4%. I think we could have gone down even more if we hadn't taken some drastic actions. That may feel like market timing to some people, but from my perspective, it takes the emotion out of it. I think my gut check in 2021 might have been after 70 new highs. I would have been like, man, we ought to be taking some risk off the table, but our quantitative research team was helping us understand what the algorithms were saying, and we didn't take our foot off the gas. And so the whole process is involved to not have a nuclear explosion in our clients' retirement portfolios. Yeah, we have some difficult riding the waves here. But yeah, I know it's really easy for people, especially when they're in retirement, to after we experienced such a positive year last year and even in previous years, that now that we've returned to volatility, we just can't let that emotion carry us away. No jumping off the cliff.
No jumping off the cliff. And so we just constantly communicate with people that, the process we follow, Matt, is fully researched, data driven, consistent, process.
Correct. I think, one of the things that I've seen a lot of lately is, headline news that contradicts each other, talking heads that contradict each other. And what we find often is, we believe everything is a new experience. There's a new war, there's Fed with interest rates and inflation. And, you can easily begin to shift or try to make changes in your account based on one or two headline news, but that doesn't actually drive the data. So all of those things, when you combine them, actually generate some type of data output. And so, we kind of just turn those noises off to say, well, what's the data actually saying about unemployment, inflation, the Fed, the war, all of those things, because they all result in data. And so the data then generates, okay, here's where there's opportunity for downside protection or upside growth. That eliminates, if this doesn't feel good or that doesn't feel good. And, I think gut checks are always good. However, that gut check could be influenced significantly based on what news outlet you're listening to. Is it spun a certain way that shouldn't be based on, political agendas and all of that stuff? And so, we just get rid of all of that. And we're finding more and more that trusting the data actually produces positive results, much greater, to Bill's point, 2 to 4% we've seen by trusting the data over, what our emotions would say. So we just have to continue to rely on that at this point. And there's no skew in that data. It's just the real raw data. And that helps generate what we need to do and why we need to do it. And the why is really the important part. And clearly explaining that sometimes can be a challenge, but it's very imperative to why we're making the decisions and where we're going.
And we can show you, as a client, if you're a client and watching this, we can show you kind of the returns over the last 20 years, what's the averages, what has happened during those time periods, how much equity, how much fixed income, all of that. It's all data driven. And we had a couple questions around the models and when is it time. So, we know that with the data that we get to kind of de-risk or take less risk in the portfolio, it's pretty hard in the data to get there, but it's pretty easy once this data reaches certain levels that we can get back in, because I'm sure everyone here wants to kind of be back into their model when it's time. So I'll leave that open to kind of anybody on the panel here on when is time, how we look at that.
Yeah, and Eric. Oh,
go ahead, Cliff. Go ahead, Cliff.
Okay. The great thing about the models and the partnership with Helios, what it allows us to do with our clients is, based on their risk tolerance, mathematically, the models have a floor and a ceiling, so, depending on the data, we're able to dial that down kind of like a light bulb getting brighter and turning dimmer. And right now it's dim. And because it's an unemotional, fact-based process, we're human. So there's times where we're almost kicking and screaming and like, this doesn't feel comfortable to do, right? But we do it anyway because we're going to follow the data because it doesn't have those emotions that we have, So when is the right time? The data is going to allow us to know that. And again, based on the risk tolerance of the client's portfolio, we're going to dial it back up. And to Bill's previous point earlier, we might go overweight equity because the data is suggesting that. So now we're going to capture a little extra gains.
Bill, did you want to make a comment?
Yeah, I worry about people getting too conservative, because if we're expecting fixed income to underperform its historical averages, which we showed on the first slide that I talked about, 1.7% over 20 years or something. The days of the retired person that's 70 years old being 70% income, 70% in bonds shouldn't be the case. They're going to need more exposure to equity, and then leave it to us to dial up the amount of equity when it's time, that'll be consistent with the models. So if you're, don't be overly conservative. The model will tell us when to dial up the risk assets. And so don't worry about having to change your model. But if you want to get more conservative, you can do that by changing the model, or more aggressive by changing the model that way too, to a moderate, from a moderately conservative to a moderately aggressive from moderate. So consider those options as well.
Yeah, it's a great point. The more conservative portfolios certainly are more challenged right now to keep up with just that inflation we talked about and so forth. So, well, let's kind of wrap up here and just ultimately think about kind of some closing thoughts as to, here we are in the second quarter, where we're at, and how do we want people to think about it? Open to anybody.
It feels worse than it is, because there's so much headwinds in our face, and we all are going to the grocery store, and we're all going to the gas pump. I think I was behind 100 people at Costco at lunch to pay $4.09 for gas, $82 to fill my truck. And you walk away from that experience, or to go to the grocery store and just buy some vegetables and fruit and a couple pieces of chicken, and it's like, what? It costs that much? So you combine what's happening with your portfolio with what's happening in real life. When you you have these experiences, it just makes it feel worse. But I can tell you that we got control of the investments, and it'll all be fine.
Yeah, it's difficult times. We're living through it, and in our day-to-day life and in the portfolios as well, and thinking about long-term plans and plans that have made, and whether or not plans may need to be adjusted. And I think this is an important to support, when we talk about risk tolerance and what is a comfort level for people individually, and remembering this and remembering what we've been through before, that, if we take time to say, hey, let's work through this Riskalyze questionnaire again, or let's talk about your timing of when you might need money, or what that dollars are for, getting back to holistic financial planning, why those conversations are so very important. So that when we do run into difficult times like this, that we know what the money is for, why it's positioned the way it is, and then stick to the data. So it's not just a process in following a process for the investment, but it's also the following the process of just prudent, pragmatic financial planning, timing, risk tolerance, and then controlling the things that you can control. We all need to buy food. We all need to put gas in our cars. But we can't control what the markets are doing, but we control how we're invested in it. We can't control how expensive something is, but we can make choices about whether to buy something or wait on something. Is it a necessity, something that we want to have, something that we wish to have? So, control the things that you can control, and that will help us get through all of this as well.
Yeah, it's good words of wisdom. And as all of us said, we know it's a challenging time, but we're here for you. What we've set up and structure and kind of how we run our models. Look, we're not guessing the market. We know that, and we've stressed that. And if you need to talk to your advisor, we're always willing to have a discussion to make sure we're on track there. And we'll keep you informed. So one of the things that I've shared a lot with my clients and others that we're constantly we are watching and reviewing it, and so we're going to continue to communicate proactively. Again, think about it as kind of the short term. Things will get better, but we got to get through this. So I'm going to wrap it up. So hopefully everything that we shared today has been helpful. We do appreciate you if you're a client. Thank you for choosing us. We'll continue to work hard and make sure we help you along your financial journey. So I hope everyone has a great rest of the week. We'll see everyone soon. And thank you again.